Okay, so I keep hearing about stock-based compensation. Is that just a fancy term for paying employees with free money?
Not free, it's paying them with new shares. When a company grants stock, it creates new shares. That's dilution. Your slice of the pie shrinks, even if the pie gets bigger.
So if I own 1% of a company, and they hand out new shares, I suddenly own less? That sounds like a hidden tax on me.
Exactly. Your share count stays the same, but total shares rise. So your ownership percentage drops. That's why per-share metrics matter more than total revenue or profit.
But where does this show up on the income statement? I never see a line called dilution tax.
It's called stock-based compensation expense, or SBC. It's a real cost, often buried in operating expenses. It reduces reported earnings, but many investors ignore it.
So if a company reports growing earnings, but SBC is huge, are those earnings actually fake?
Not fake, but inflated. If SBC is, say, 20% of revenue, then real cash earnings are lower. You must subtract SBC from net income to see true per-share value creation.
Got it. Now what about basic versus diluted share counts? I see those on every earnings report.
Basic counts only shares outstanding now. Diluted adds all potential shares from stock options and grants. If diluted is much higher, future dilution is coming. That gap is your warning sign.
Can you give me a real example? Like a company that grew earnings but still destroyed per-share value?
Think of a tech startup. Revenue doubles, net income grows 50%, but they issue so many shares that EPS actually falls. Investors cheering the headline miss that per-share value dropped.
So what's the practical takeaway? How do I check if a company is eating my investment?
Compare diluted EPS growth to basic EPS growth. Also track share count over time. If shares outstanding rise faster than earnings, you're losing per-share value, no matter how good the story sounds.
What about buybacks? Don't those cancel out dilution from stock grants?
Sometimes. If a company grants 5 million shares but buys back 5 million, net dilution is zero. But if buybacks are smaller than grants, dilution wins. Always check net change in shares.
So buybacks can be good, but only if they actually offset SBC. How do I see that quickly?
Look at the cash flow statement, stock-based compensation under operating, and repurchase of common stock under financing. Compare the two numbers. If SBC is bigger, dilution is happening.
Final question, as a beginner, what's the one number I should watch to protect myself?
Watch diluted earnings per share over 5 years. If it grows steadily, you're fine. If it's flat or falling while revenue rises, run. Per share value is the only truth.
That's super clear. So always think per share, not total. Thanks, Jordan. I'll start checking diluted EPS first thing.
You got it. And remember, a great business can still be a bad investment if management pays itself with too much stock. Stay sharp and happy investing.